Okay, well, I want to shift our focus away from debt funds to equity funds. And here's a very interesting trend that we have been observing. Mid-cap and small-cap funds, as we know, especially if you pick a time horizon of the last 3 years, if you people have been investing or started investing in mid and small-cap funds since maybe say 2016 or 17, you're definitely going to be very disappointed, because largely mid and small-cap funds from a time horizon of 3 years have either given zero or negative returns. The average performance of a small cap fund in a 3-year time horizon has been negative 4%. In the year 2020 as well, mind you, the performance has not been that great. It has been a negative 2% for small cap funds, negative 2.6% for mid cap funds. But remember, 2020 is of course a year of disruption. Look at the performance in a large cap fund. It's been negative 7%. In fact, if you look at the table comparing returns in 2020, 1 year, 3 year and 10 years, you'll notice that there is underperformance by a mid and small cap fund only in a 3-year time period. You put any other time period and they have actually done well. So let's then talk about your strategy in investing in a mid and small cap fund, especially when they do tend to outperform for many of the time horizons except for maybe a 3-year time horizon. For that, I have with me Pankaj Tibrewal, the Senior VP and Fund Manager of Kotak Mutual Fund. He in fact manages the mid-cap and small-cap fund of Kotak Mutual Fund. So Pankaj, thank you for joining us today on ET Now. Really appreciate you giving us your time. So to start off with Pankaj, what's your view on this, bout of outperformance that we are finally seeing in mid and small caps? I mean, when there is so much uncertainty, one would think that, okay, you want to go with, large companies and, maybe nifty 100 companies, but instead we are seeing a good bounce in mid and small caps. What do you think is driving this?
Over the last 3 years, the broader markets have not done well. And since January 2018, mid and small caps have seen sharp pullback, and broader markets have been in pain for almost last 30 months. Mubina, the current downturn in the mid and small cap is already one of the longest and the deepest, especially for small caps. If you look at the period between January 18 till 23rd March 2020, when markets made a bottom, almost 80% of the top 1500 companies by market cap have already corrected by more than 50%. And almost 70% of them had corrected by more than 60%. This kind of a price damage was or is already similar to the 2008-9 GFC crisis, as we have been under weak economic conditions for the last few years, even pre-COVID. So our view was that when COVID hit us, that this is not the start of a new bear market. We have been in the bear market for almost 2.5 years, which is almost 30 months. And probably post some turbulence in the next 6-12 months, till the COVID issue settles down, you will see some volatility in this space. But broadly, the damage had already been done. And valuation at some point will take a support. And that exactly has happened. Even during the financial crisis, if we go back, the pain in mid and small caps were not for so long. Our view is that the current divergence between performance of large and mid cap, small caps is at historical extremes. And if you look at the relative valuations of the space vis-a-vis large caps or Nifty, it has corrected back to 2014 lows. And Mubina, history suggests that such divergences don't exist for too long. And post such large underperformance, the space tends to come back and outperform. And that is our view, that if one takes a 2 to 3 year view, the space has the potential to outperform large caps over the next 3 years. Also, we believe that in the near term, there will be some mid and small cap companies which will face trouble because of leverage, because of high fixed cost, because of tight credit and demand conditions led by lockdown. But we can't generalize the same for the entire universe in our view. There are many companies in this mid and small cap segment across various sectors like tiles, plywood, agrochemicals, auto ancillary, specialty chemicals, IT, consumer durables, which are strongly positioned on both balance sheet and cash flows. And in our view, they would benefit immensely through increase in market share during this downturn. We are focusing on such companies which, in our view, would be able to navigate the downturn and emerge stronger. We also believe that FY22 will be a more normalized year for economic growth because probably there won't be any lockdown for 2 months. And when economic turns the corner and growth rate increases, we believe that the broader space, which is represented by mid and small cap, should benefit. Our belief is that bottom up stock picking approach would be rewarded in this space going forward.
Okay, now Pankaj, of course, the world that we'll enter, I hope when we come out of this whole COVID crisis, which will be soon enough, will be very different. I want to know what kind of changes are you making in your portfolio to sort of adjust to this new normal? I mean, how are you ensuring that your fund will be poised to outperform and do well, even in this COVID era or in this post-COVID world?
Actually, we haven't made too many changes in the portfolio over the last few months. In fact, we have added to our position in many of our investee companies where we felt that the price had become too attractive post correction. And, and the companies which would survive in our portfolio in this downturn, and the long term value of the business continues to be intact. The template which we use for selection of our investee company, which has helped us in this downturn, are as follows. One, good and sustainable businesses. What do I mean by that? The businesses which have competitive edge, moat. It can be in the form of R&D, it can be in the form of distribution, products, uh, business opportunity, run by great and honest managements, which have high level of integrity and available at an attractive price. During the downturn, when we do a DCF, which is discounted cash flow of our investing companies which don't have leverage, we saw that even if we drop the profits of year one by 50 to 60%, and we do your 10-year DCF and assume a terminal growth rate of 2 to 3% for our investing companies, we saw that the long-term value of that business is not changing by more than 8-10%. And there we took a call that if the price damage has been far more, but the long-term value still remains intact and the business becomes stronger in this downturn, we actually went ahead and added to our a lot of position in our portfolios. Also, we believe that most of our investing companies are able to generate sustainable capital returns, which is return on capital and return on equity, and which we have seen over longer periods of time, which is above the cost of equity, and hence have created shareholder value. And we saw that many companies will actually post in downturn enhance their return on capital and return on equity because their growth rates would be much higher. So going by this template, we actually showed our conviction in across our investee companies and increased position. However, one theme which we are very positive on, and especially in the broader market space, is the China plus strategy or the China substitution theme. We have been playing through specialty chemicals, uh, consumer durable electronic manufacturing, APIs, pharma, and some of the consumer discretionary names. This positioning was not done in the last 3 to 6 months, but since the trade tension started between US and China, I think COVID has accelerated that, and we have seen that government introducing PLI schemes in mobile manufacturing, then in APIs, and I think it's a great move towards self-sufficiency of a lot of things inside the country. And I think the mega trend in the next probably decade could be manufacturing in India. We believe that the ecosystem which the government is trying to create is the step in the right direction, and we are extremely positive on such theme and have positioned our portfolios accordingly in many of these sectors which I just mentioned. The other thing which we believe probably is in its last stage probably is real estate. There may be some pain for next 6 to 12 months where further consolidation would happen. Builders, because of lack of funds by NBFCs, will probably fold up or give way to the stronger balance sheets in this sector. But if you look at a couple of things, the sector is probably, after 6-7 years of stagnation, probably preparing for a up move. Though there are not too many builders, developers, which fits our return on capital or cash flow or balance sheet criteria, but we have started to position our portfolios for this up move through the ancillary sectors like tiles, plywood, pipes, cement. And we believe that over a 3 to 5 year period, many of these companies which have stronger balance sheet will emerge further stronger and growth rates would increase. The third sector is cement, and we clearly saw the surprise in the first quarter numbers even because of lockdown. And cement as a sector has done extremely well, and that is reason because of consolidation again. In every region, the top 3 4 guys are now commanding 60 to 70% market share. And we believe that after a decade, the profitability of cement companies is probably having a reset, and probably the next profit cycle is just about to start in the cement sector. So broadly, we have position, and apart from that, the other sectors where we have been positive upon is both domestic and US centric pharma companies, selected IT companies. Where we have been underweight is financials, especially NBFCs, and only position which we have in financials is the large sector, private sector banks. So that's where our thought process is in terms of portfolio positioning. But one trend is very clear, that the leader will become stronger in every sector, whether it represented by large caps or mid caps. And the balance sheets and good cash flows and lower fixed cost will be rewarded disproportionately in the next 2 to 3 years.
Okay, Pankaj, how have you tackled, or have you had to actually tackle with any disruptions to companies in your fund? Maybe a company, has found themselves in sort of a tricky spot because of the COVID disruption, or maybe even downgrades, to companies that have been present in your fund?
It will be a very small portion of our portfolios where we tinkered with. Uh, Generally, if you look at our philosophy over last many years, we have avoided companies with weaker balance sheets, high fixed cost, inferior cash flows, high financial leverage, and corporate governance issues. And if you look at in this downturn also, the companies with these characteristics have been punished. And probably by avoiding them, we had a very good night's sleep. And we also avoided companies where we believe that the capital efficiency is poor and it won't earn return on capital higher than the cost of capital over sustainable periods of time. I think by following this philosophy over last many years, it has helped us in this downturn as well. Yes, there will be near-term impact which will be there in FY21 earnings, even if the company is non-levered because of purely lockdown. Because for 2 months out of 12 months, which is 16% of the time, the economy didn't function, and that had an impact on across the board, barring few sectors. So we acknowledge that fact, but we see that how many companies are able to gain market share. What is the position of the free cash in the company even in this lockdown? And one exercise which we did, Mobina, is to look at our investee companies and give them a framework in terms of management. We believe that the performance of two companies in the same sector could be very different this time if the management has not seen the previous crisis. So we went and saw that how many companies in our portfolio have the same management which were there in the previous crisis, and how they have grown after the crisis. And in one of our portfolios, the midcap portfolio, we were pleasantly surprised to see that 70% of our investee companies have the same management or promoter, which was there in the previous 2008-9 crisis. And they grew very nicely without diluting balance sheet and cash flow for the next 3 years post-crisis. About 22% of them have seen one management change. So I think giving this as a framework, what we believe that it will give us more confidence that these management or promoters have seen the previous cycle, taken right decision during the crisis, and over the next 3 5 years they grew very nicely without diluting balance sheet and cash flow. So that's another thing which we did in our portfolios, and we were pleasantly surprised that 70% of the investee companies have the same management of the promoter compared to the previous cycle.
Okay, excellent. Pankaj, just before I let you go, just some closing comments from you. A lot of investors have unfortunately had to perhaps pause SIPs, or in a worst case scenario even redeem their SIPs to tackle this crisis, to help them get some cash to tackle this crisis. Do you think that if they've been able to come out of this crisis, they should immediately restart SIPs, or perhaps even increase SIPs in mid and small cap funds? And what would be your message to investors who've been a bit flustered because of the recent fall in NAVs?
I mean, last 3 years, the markets have not done anything. And if you look a month or two back, the 3-year returns were negative. So it's justifiable for investors to get a bit edgy. But this is not for the first time we are seeing such a scenario. If you go back to starting 2000, I still remember in 2000, 2001, when we went to investors, people showed us the last 10-year returns and echoed the same sentiment which is there around, that for the last 10 years, markets have not made money. What makes you believe that the next 5, 10 years will be good and we'll make money? And after that, we saw the biggest bull market in India and globally. Similarly, in 2013-14, the same sentiment was echoed, that last 4, 5 years returns have been very poor, and why should we invest? And the next 3, 4 years, we saw a very strong rally in the Indian markets. The same sentiment has been echoed now, that last 3, 4 years have not been good. But if you look at the way things are moving in and post-COVID, we believe that a lot of consolidation will play out in many sectors, and the way it is happening. The, the time to increase SIPs is now, and have a proper asset allocation, which we have always been advising. This, in our view, is not the time to stop or redeem SIPs. This is actually a time to do rupee cost averaging, and probably, in our view, next 3 to 5 years, there'll be at least 1 or 2 years which will be extremely, extremely rewarding for the broader market space. And probably then investors should review what they want to do. But today is not the time. Today is actually the time to either double up or average your rupee cost averaging in this downturn. Also, just one example which I would like to give. Look at one of our mid-cap fund, Kotak Emerging Equity. In the short term, there's a lot of noise, there's a lot of sentiment flows which moves the market. And in January 2020, before the COVID hit, the 1-year SIP was 26% plus return. Then in March, the fund gave negative 41% on a 1-year basis SIP return. And in April, the SIP return came down to minus 21. And as we speak, the SIP return on a 1-year has now become positive. The point which I'm trying to derive is that in the short term, there will be a lot of fluctuation, lot of movements, wide movements which we saw the way pre-COVID and post-COVID, and now the SIP returns are. But if you take a 5-10 year period, I'm very happy to see that the SIP returns are still quite meaningful. And my only advice to investors would be that don't that during these downturns, the temperament and emotion quotient is the most important part. And don't look at only the past returns, look at what is happening in the country going forward. And we believe that after a long time, government is in the right direction towards encouraging manufacturing. The world is looking upon to us. And I think this decade, if we do the things right, will belong to India. So don't be very short-term oriented. Probably have a 5 to 10 year view for equities in the market. And if you give that, I don't think investors will be disappointed.
Don't be too short-term oriented. Keep a long-term time horizon. Pankaj, thank you for joining us today on the Money Show. And yes, Pankaj raised a valuable point. You know, the sentiment right now is very similar to what it was in 2013, in 2000 as well, when the prior 3-4 returns were very weak, but subsequently what followed were great returns by mid and small cap funds. Their own fund as well has turned positive on a one-year SIP basis. Okay, we'll do one thing. We'll take a very short break right here on the show. Don't go anywhere.